Are we there? Are we there? And can we commence? Are we there and can we commence? So we were on regulatory framework. And we did talk about some of the functions of ISPAC. Then we had a number of bodies. We had a number of bodies. On this, we can talk about body and their functions. We can pick on bodies and their functions. I want to pick on a number of bodies. We have IPSAS board. IPSAS board. And IPSAS board basically means international. This is international, public, international public sector. We call it the international public sector. Accounting board. That is the IPSAS board. So one of the functions of the IPSAS board, we say is basically to set, we say set international public sector, what's called international public sector accounting standards board, accounting standards, international public sector accounting standards board. For that is IPSAS board. For say for use by the public sector. For use by the public sector. Basically for the use by public sector. We can also IASB, that is international auditing. This is what you call international auditing and assurance we have it standards board, international auditing and assurance standards board. Basically the role of this is to set, set international, call it international standards on auditing, and you have assurance and engagement, and related services. So we look at these various regulatory bodies and their function. I've talked about IPSAS board, that is international public sector accounting. So they set the standards for the public sector, for the international public sector. We can also have what we call ESB. So that is basically international accounting. This is what we call international accounting education. Call it international accounting education standards board. International accounting education board. So this is basically to develop this regulatory body is basically to develop what we call education, developing education standards. This is basically to develop education standards. And then we have others altogether, international standards altogether. We have what you call international. I want us to talk about international, briefly international, what you call international accounting standards. Accounting standards, standards board. So International Accounting Standards Board, that is IASB, International Accounting Standards Board. What is the role of International Accounting Standards Board? Basically, do we say is International Accounting Standards Board? International Accounting Standards Board. International Accounting Standards Board. So one of the things we need to understand that this is independent. Independent. It's an independent. That is International Accounting Standards Board. That is basically independent. Comma. Private sector. Private sector body. Call it the private sector body. Then we know that International Standards Board is an independent private body that develop, we say develop, they come up with, and we call approve. Develop and basically approve, and approve IFRS. IFRS, that is International Reporting Standards. So we say that this is independent private sector body that develops IFRS. So I can note it there, IFRS. So when you ask what is International Accounting Standards Board, they basically develop IFRS. Together, team. Are we together? If you're together, we respond with a yes. Basically develop IFRS. Are we together? Together. If you're together, we respond with a yes. Are we together, team? Joseph, are we together? So we proceed to the role. What is the role? We saw role of IASB, International Accounting Standards Board. Together, team. If you're together, we respond with a yes. If you're there, we respond with a yes. Can we respond with a yes if you're there? Jane, are we there? If you're there, then we respond with a yes. Can you hear me? So some of the roles of this International Accounting Standards Board, we know that we have one is the approval, what you call approval, and issuing, what you call approval and issuing of international interpretation, developed by IFRS. So basically the issue approval, they basically issue I've unmuted everybody. So one of the roles of IFRS, International Accounting Standards Board, we say approval and issuing of international interpretation, but developed by IFRS, international financial reporting standards, interpretation committee. That is one of the role of International Accounting Standards Board. So second, we say that preparation. They also prepare IFRS preparation, what you call preparation, and issuing, what you call issuing of IFRS. And IFRS, International Financial. I've unmuted everybody. International financial reporting standards, the preparation and issuing of international reporting standards altogether. Again, that means other than interpretation, they also prepare and issue that we together. Then you can talk about the last one. That is what you call the full discretion. Full discretion. We call it the full discretion. In developing, we have full discretion in developing. And pursuing, what you call pursuing, and pursuing its technical agenda, what you call its technical agenda, subject to certain consultation, requirement, certain consultation requirements, with the trustees, and the public. So those are some of the three roles of International Accounting Standards Board. Together, are we
Yes.
together now? Perfect. So I want us to go to accounting standards. What you call accounting standards. And basically we want to look at importance, and limitation. I want us to try and finish this in limitation. So what are some of the accounting standards that you know? So basically, what is accounting standards, number one? When you say accounting standard. What is an accounting standard? When you talk about accounting standards, what do we mean? Before we talk about their importance or characteristics, you know, what is accounting standards? What is accounting standards? No, guidelines that basically you follow the basically guidelines or procedures that are used when accounting for affairs of most governmental and non-governmental bodies. So basically say that accounting standard set, they set, these are basically set standard. We call them the set standards and guidelines. We say set standards and guidelines. That's basically what we call the set standard and guidelines. Guidelines. And procedures, we say procedures that are used when accounting, that are used when accounting for the affairs of non-governmental, governmental, and what you call the governmental entities. So basically we say that when you talk about accounting standards, we say that these are set standard guidelines and procedures that are used when accounting for affairs of non-governmental and governmental entities. What are some of the accounting standards that we are aware of? Accounting standards that we are basically aware of. Some of the accounting standards that we know. Who can give us at least one of the accounting standards that you know before we talk about relevance? Who can give us an accounting standard that they know? Who can give us just one accounting standard that they know? Accounting standards and concepts. What are some of the accounting standards that we know? Who can give us any accounting standard that you know? So again, we need to understand that accounting standard brings what we call uniformity. Uniformity brings uniformity in preparation. In preparation, uniformity, what we call in preparation, and reporting, reporting, and ensure what you call ensure consistency in the data published by enterprises. Imagine, for example, if you didn't have accounting standards, in terms of preparation, how would entities prepare their financial statement? There would not be aspect of uniformity in terms of reporting, and again in terms of presentation. So basically, these accounting standards that we know are together. These accounting standards are together. We know that if you look at when you're talking about accounting standards for public sectors, they bring uniformity in the public sectors. If you look at public sectors, they will be prepared using the same standards altogether. And that is what you're saying here, that when you talk about accounting standards, they basically provide uniformity in terms of preparation reporting, and they also ensure consistency basically in the data published by enterprise. Uniformity in the data basically published by an enterprise. Are we together? Are we together? Together, team? I want us to respond if you're together. So very important, I want us to understand if that is given. I want us to understand that. We're saying that for accounting standard, we're basically saying that for accounting standards to be useful, basically saying that for accounting standards to be useful, and enhance, and basically enhance, to be useful tools, to be useful tool, to enhance the corporate governance, the corporate governance, to enhance the corporate governance and responsibility, two criteria must be satisfied. That in order for accounting standards, we know that accounting standards, one thing that we say, they provide guidelines. They basically also any procedures that are useful when accounting for the affairs of both governmental and non-governmental. Are we together? But you said, again, when you look at those standards, they basically provide uniformity in that if you're looking for accounting in terms of public sector, the standards for the public sector, if you look at all public sectors, then there's some level of uniformity in terms of preparation. But here I'm saying that basically for accounting science to be useful to enhance what you call corporate governance and responsibility, two criteria must be satisfied. What are those criteria that must be satisfied? One, a standard. When you say a standard, we basically say a standard. We say must provide. Generally, what you call generally, must provide generally, what you call understood, and accepted, measure of phenomenon of concern. So for it to be used as a tool of corporate governance, so one of the things that it must provide, you say generally understood and accepted measure of the phenomenon concerned. Are we together? Then the second, it should significantly, we say significantly reduce. We say significantly reduce the amount, what you call the amount of manipulation. Basically, we say amount of manipulation of the reported, what you call of the reported. Of the reported members. To significantly reduce the amount of manipulation of the reported members. So those, for it to be used as a tool to enhance corporate governance altogether. So importance, we proceed to importance. What are some of the importance of accounting standards?
We've seen to create uniformity, to allow to create uniformity when reporting financial.
Definitely, uniformity. Another one? Apart from uniformity in reporting? Apart from uniformity, what do you say? Again, you can also talk about aspects of transparency, transparency. These standards also provide the aspect of transparency. Are we together? Then again, we can also bring the aspect of comparability. You're able to compare accounting for one organization to another. Are we together? Then we have what you call relevance and what you call audience altogether. Relevance and audience altogether lies in the value varying relevance and audience altogether. Those are some of also importance altogether. So you can do a bit of research on this comparability. You're able to bring that aspect. There's the aspect of transparency. You can read that. Transparency is what you call relevance. They bring relevance, and you can also look at what you call audience. So we proceed to limitations. You have them limitations of accounting standards. What are some of the shortcomings? Limitations are basically shortcomings. What are some of the shortcomings of these standards, accounting standards? What are some of the shortcomings of accounting standards? Limitations of accounting standards, so shortcomings. shortcomings. Limitations of accounting standards, shortcomings of these standards. One of which they cannot override. They cannot override, say override statutes. They cannot override statutes. So they cannot override, meaning that they cannot go against the state statutes. They're basically within, we say that they are required to be framed within the ambit of the prevailing statutes. Statutes are probably laws are together, so they cannot override it together. Then you can say they may be a trend. So what you say, a trend towards rigidity. Some are very rigid. Rigidity, you find some accounting standards are very rigid. You cannot alter them. Rigidity, in a way, from the trend towards rigidity and away from flexibility. So that's another limitation. If you look at some of the accounting standards, you cannot very rigid. And maybe if they're not very good standards, that is a limitation. Then we can proceed to the next. The last one on limitations of accounting standards. We can talk about alternative. That you say alternative. What you call alternative? Solutions to certain. Alternative solutions to certain accounting. What you call to certain accounting problems. So certain accounting problems may each have arguments. May each have arguments to recommend them. To recommend them. So say alternative solution to accounting problems may each have arguments to recommend them. Therefore, alternative solution to certain accounting problems may have arguments. They may be conflicting. That is basically to say they may be conflicting. Therefore, choice between different alternative accounting treatment may be difficult. You'll find those standards may conflict altogether. So therefore, choosing between either of these two standards may be difficult altogether. Then briefly, I want to talk about professional ethics. This is some of the questions that you need to solve very fast. Professional ethics in accounting. Ethics in accounting. As a professional accountant, what are you expected? For example, as a professional accountant, what are some of the values that you're expected to uphold as an accountant? So that ISPAC, Yezi, Chukua, maybe they register you. What are some of the ethics that you need to uphold?
Accuracy.
Ethics.
Accuracy.
I'm not talking about quality of a good accounting information, but I'm talking about professional ethics. We know that ethics is the code of conduct. When you talk about ethics, that is basically the code of conduct. So as an accountant, professional accountants are required to uphold to which code of conduct? One of it is integrity. Are we together? Who was that talking? Integrity. And when you say integrity, that is basically straightforward. This is to say straight, forward, and honest. Together, straightforward and honest together. So one of the values is integrity, which you basically say that is straightforward and honest altogether. Then objectivity. The next should be what you call objectivity. Objectivity is what you call objectivity. That is the next. When somebody is objective, what do you mean? As a professional accountant, you should be objective. Should not allow biasness. Not allow what you call biasness or conflict of interest. Conflict of interest. You should not allow biasness or conflict of interest. You should not allow biasness or conflict of interest. Then you have what you call professional competence, and due care. What is professional competence and due care? Lavender, what do you mean by professional competence and due care? We're almost done with this topic one. Professional care competence.
You should be well conversant with what you're doing.
Definitely, you if it's skill, it should be a top notch altogether. Maintain professional knowledge and skill at a high level to ensure the client receive competent altogether professional service. So that when you're looking at the books of a client, you make sure that the client is able to receive top notch level of competence altogether. Then again, confidentiality. What is confidentiality? When you say you're confidential, what do you mean?
Not sharing financial information with irrelevant parties.
Yes, with only, if you have a client, why would you give information of your client to competitor? That is not ethical. Then we have lastly what you call professional behavior. Once in a while, this question normally comes. What do we call professional behavior? That is basically comply with relevant laws and regulation. Relevant laws and regulation. Should be able to comply with very relevant laws and regulation, and should not avoid any action that discredits the profession. So a very good area, that is accounting, what you call accounting concepts, and principle. I want us, this principle is a very common question. The very first questions you find touches on principles, those theory. What are accounting principles? When you say accounting concepts and principles, before we talk about those principles. Before we talk about those principles. Accounting principles. So basically, these are concepts and principles. These are principles, we can call them principles that underlie, that we say underlie the preparation, what you call the preparation of accounting. These are principles that basically underlie the preparation of accounting. I want to pick each one. I want to start with the very important one. I want to start with what you call accrual concept. Accrual concept. We start with what you call accrual concept. The first concept comes now, what you call accrual. What is accrual concept? Accrual concept. Accrual concept ni nini? What is accrual concept when you're preparing that principle? What does it say? Accrual concept. Accrual concept. In terms of preparation, for example, when you're preparing, when do you record income? When do we record income? When do you record income? For example, somebody was saying something on accrual concept.
No,
What
I
does it
wanted to
say?
say
You wanted to?
on income. You asked when you record income.
Yes. Proceed. Your name?
Jen, you record
Proceed.
income when a sale occurs and not when payment is made.
And not when money is received. So that is an accrual.
Yeah.
One concept is that, when you talk about income, we basically record income when they're earned and not when money is received. And when it comes to expenses, we basically record expenses when they're incurred and not when money is paid altogether. That's why if you look at, for example, accrued income, you'll always add it to income that is already paid. Accrued expenses, you will always add it to expenses that are already paid altogether. So on this, we can say as the first principle, requires income and expenses, income and expenses to be recognized. We say to be recognized to be recognized in the accounting periods to which they relate rather than the cash basis, That's the same thing altogether. So it requires that income and expense to be recognized in the accounting period to which they relate to rather than the cash basis. So that is basically to imply that incomes are recorded when earned. So that's the period when earned and not when received. And expenses are recorded when incurred and not when paid. So we say incomes are recorded when earned and not when money is received, and expenses are recorded when incurred and not when money is paid. That is an accrual concept together. That is the first concept to discuss. Kila mtu ameelewa? Joseph, do you understand that concept? And you say we have to close this together today. So I want us to talk about the second, what we call the duality concept. What is the duality concept? If you pick on that. What is duality concept? Duality is the same as double entry, what you call double entry concept. So what is the double entry concept? It's a very fundamental principle. Actually, when you're doing accounting, this concept of duality is the double entry concept. What does it state? Lavender or Jordan? Lavender, what does duality concept basically tell us? What does double entry? We know that this is a fundamental. Fundamental.
The debit and the credit.
Yes, principle of accounting. To say that accounting, every transaction has two sides. Every transaction has two sides altogether. So that basically to mean that every transaction always affects two accounts, and that is the debit together. Transactions normally have, I can just say, debit and a credit together. Debit and a credit. For example, we can pick two sides of it together, twofold aspect of accounting, where we have give and take, and that is what we call debit and credit. Let's say, for example, we go and withdraw money from your bank. Stacy in Pasha. Stacy would withdraw money in your account. What happens to your account? Stacy, when you withdraw money from your account, what happens to your account? Your bank definitely reduce and your cash increases altogether. So every time if you go to the bank and withdraw money from your account, one of the first things that happen is that your bank will reduce, but the second thing is that your cash is going to increase. Both bank and cash are current assets. So if a current asset reduces, like the bank, we are going to credit the bank. But cash, which is also a current asset, is increasing, we are going to debit. We credit with the same amount and we debit with the same amount. Together, team. We credit with the same amount and we debit with the same amount. So there's a very good concept which we call business. We call it business entity concept. What is a business entity concept? When you say business entity concept, so this business entity concept, it basically says that business is separate from the owners. Are we together? So when you have transactions and balances of the business, it should be accounted separately from the owner. Are we together, Paris? So business entity concept, it basically separates the business and its owner. So if you have business transactions and balances, we should basically account them separately from the owner. Are we together? Together. I want somebody to respond with yes, so we can say
yes. Yes.
Okay, financial. These questions you'll find them just basic financial accounting, but we are finishing them on today. I'm not covering topic one again. It's based. I'm just covering a few based on the premise. We say based on the premise. We say based on the premise that the transactions and balances of a business entity we say business entity of a business entity are to be accounted separately, from, say, from its owner, are supposed to be accounted basically separately from the owner. So business entity basically brings a clear distinction from owner distinction from the owner and the business. Then another one that we know some of the concept that materiality. We have what you call materiality. What you call materiality concept. This, I think you touch it on number. What is materiality concept? What is materiality concept? And when you say something is material, materiality, what do you mean by materiality? When something is material, basically we say that it's omission or misstatement. Basically omission and misstatement. We say that omission and misstatement could influence economic decision of users. So basically materiality, material, just say information. Information is material if it's omission or misstatement, its omission or misstatement could influence is what you call economic decision, could influence economic decisions of users taken on the basis of financial statement. I want to ask a very simple question, If I was to Mercy Monique, if I was, for example, Monique, Monique, I was to take 2,000 from you. Is it very material? Would it affect much of your life if I was to take 2,000 from you? How big would it influence you? How bad would it influence your life if I was to take probably 2,000 from you? Maybe in a big way. So that is very material. So when you talk about materiality, so in simple words, materiality relates to the significance. We say materiality concept relates to the significance. Remember, accounting we deal with transaction, significance of transactions, comma, balances and errors, balances and errors, contained, we say contained in the financial statement. So basically we're saying that materiality basically relates to the significance of transaction, balances, and errors contained in the financial statement. How significant? How do they affect the financial statement? And I just pick major ones. You can discuss major one. What you call consistency, the principle of comparability or consistency. What is the principle of consistency, which you can call comparability? Comparability or consistency. What do you think this principle is? Comparability to consistency. Very important. This is a kwanza for us to at least start on them. What is consistency to comparability? What is comparability or consistency? What you call comparability or consistency? So we know that accounting statements of one accounting period must be comparable to another from one season, are we together to another, So consistency, the principle that we apply today, we must apply. We should have consistency in application. So that is what you call the principle of consistency, consistency or comparability. We can have something on realization. Realization was a very good one. Realization concept. So realization concept. So this is what you call revenue. Revenue recognition. What's called revenue recognition principle. So when you talk about consistency, one accounting concept should apply from one season to another. That is consistency, where you have one accounting principle being applied from one. The same. If you're accounting for asset, then you need to account for asset the same way from year 1, year 2, year 3. That is consistency. So what is realization concept or revenue? You tie it to accrual concept. So that is basically application. We call it application. Application of accrual concept. Application of accrual concept towards what you call recognition, towards recognition of revenue, so income, towards recognition of revenue towards or income. Under this principle, so under this principle, it's just the same. Revenue is recognized by when it's earned. Revenue is recognized when earned, irrespective of whether cash, irrespective of whether cash has been received or not, irrespective of whether cash has been received or not. That's why normally when you talk about sales, we'll always have, for total sales, we'll always have a credit sale, are we together, and cash sales. Something else that we need to add, matching concept. That is a matching. We can add 7, what you call matching concepts. What is a matching concept? So principle. Then I'll talk about prudence. Principle. What is matching concept? Some are matching concept. What do you mean by matching concept? So matching concept basically says that, expenses incurred by organization must be charged to income statement in accounting period in which revenue is earned altogether. That is the matching concept. Requires, so we say that requires that expenses incurred require that expenses incurred by an organization must be charged to the, we say must be charged to the income statement, must be charged to the income statement in the accounting period, in which revenue, to which expenses relate is is earned. In which revenue to which expense relate is earned together. Somebody just tell me the last one. We can talk about the last one and the other ones you get from there. Prudence. What is prudence concept? Prudence concept. I expect this is participation. A lot of participation. What is prudence? When you say prudence concept. Prudence concept. We also have objectivity concept. When you talk about objectivity concept, remember we talked about objectivity as a professional ethics, code of conduct. What about objectivity concept? That is not allowing biasness. But what is prudence? Who can give us what prudence means? Concept. Prudence concept. What is the prudence concept? David Ochola, prudence concept. David Ochola, prudence concept. These two are substance over form. We have substance over form. We have the prudence concept and substance over form. So basically when you say prudence concept, a lot of caution, we talk about degree of caution in adoption of policies, and that is basically prudence. So we can just say company, on prudence we say company should not recognize, company should not recognize an asset at a value that is higher. We say a value that is higher than the amount expected to be recovered from its sales or use. You should not recognize an asset higher than the value that is expected to be recovered from its sale or use. Then substance over form. What is substance over form? So this can be your assignment on that. So we can pick on something, quality of good accounting information. Together, team, I've discussed a number. And this is your assignment. You can just go and check substance over form. And those others. To go south, we respond with a yes if we are together.
Yes.
I want to summarize this, then we'll see how we start topic 2. Those are qualities of a useful accounting information. On qualities, and these are very common questions. Qualities of useful, what you call useful accounting information. You just find them. 4 marks, 5 marks, 8 marks, maybe 2 marks information. And these are some of the areas that people you find fail. For the calculation, you'll always find you have something particular. So qualities, we have a number, we just write them down to call a relevance. 2 is timeliness. Timeliness. 3, we have what you call. 3, we have what you call. Timeliness. Reliability as a quality. 4, consistency. And 5, we have comparability. Quality of a good accounting information. 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 So we close it, then we get to topic 2. Quality of a good, when you say relevance, what does it mean? Relevance. What is relevance? So information, basically accounting information should be basically for predictive and feedback. Accounting information should be basically for predictive and feedback. So if investor cannot review accounting information for a company and assess its worthiness, then it's not relevant. It's not relevant altogether. So we say that 2 aspects, that accounting information is basically for predictive and feedback altogether. So as an investor, if you cannot review accounting information for a company and use it, assess its financial worthiness, then we say that information is not relevant altogether. 2 concepts that we talk about. That accounting information is basically for 2 concepts, predictive and what you call predictive and feedback altogether. So if you analyze and it's not able to provide feedback, we know that that accounting information is not relevant. What about timeliness? It just basically says that accounting information should be presented in a timely manner. Are we together? Timely manner that is useful to investors and those that require it altogether. What about reliability? Reliability inamaanisha nini when you say reliable? If you cannot use it to make decisions, if you cannot depend on it to make decisions, then that accounting information is not reliable altogether. Then we have consistency. Again, that information should be able to apply from one accounting period to another. Then that is consistency. Comparability. So you should be able to compare from one period to another. See the variance, and that is the comparability. So that marks topic 1. That marks topic 1. So that is the end of topic 1. I want us to proceed. Just wrap here and have topic 2. Have here and have topic 2. And have topic 2. So we start on topic 2. Are we started on topic 1? Is there any question on that topic 1? Just a summary of that topic 1. That topic 1, is there any question on topic 1? So start with topic 2. Topic 2. That is basically on recording transactions. Together. Recording transaction. Topic 2 on a fresh recording transaction. Where does accounting start? Do you know what you call accounting cycle? Where does accounting start? How many steps do we have in accounting? Where does accounting start? Accounting inaanza na wapi? You don't go, don't leave. We still have a class. Where does accounting start? Accounting inaanza na wapi? Just a summary. These are basics, and you need to understand the basics. If we skip those basics, it will not be very healthy for us. Where does accounting start? On topic 2, that is recording of the transaction. Where does accounting start? Where do you start in accounting? Somebody to try? Somebody to try before I give you a small break. Where does accounting start? It
You
starts from?
identify the
Hmm.
identification, identifying if something is a transaction.
So we have transactions. We first of all start with transactions, you know. Transaction, we have a transaction. So transaction, how do we identify transaction? When you talk about transaction, when you have transaction, how do you identify? Accounting starts with the transaction. From a transaction, where do you get to? I just want to see whether you understand the accounting cycle before we start with those source documents. Once you understand that concept, even the source documents becomes very easy. So accounting starts with transactions, then we move to what we call vouchers, stock source documents. I know we've started with source documents. So transaction, when you travel, are we together? There's a transaction. So when you travel, there's a transaction. Are we together? When you travel, who was talking? Joseph, Jane. When you travel, one of the things that you'll be asked, where is the documentation? Are we together? So then from transaction, you'll be asked for source document. I hope you can see. Then you have, from source document, we have books of original entry, stroke prime entry, books of prime entry, what's called the books of prime. The prime entries will basically move to, what do we move to? Are you able to see what is at the corner? Are you able to see what is at the corner?
No, it's not visible.
It's not visible. Let me just grab this on the side so that we have it on this end properly. So we have what we call business transaction. It starts from the transaction. This is the business transaction. From a business transaction, we have voucher stock source, what you call the source documents. Voucher stock source documents. Together, team. Are we together?
Yes.
Yes.
Then
Yes.
what the source documents, we basically have what you call books of original entries. Books of original entries. We have it there. The next thing to pronounce hapa we have ledgers. Ledgers. From ledgers to nini? On that accounting cycle. On that accounting cycle.
Trial balance.
From ledger, we go to trial. We have the trial balance.
Balance.
Trial balance. We have the trial balance. From trial balance to nini? From the trial balance, what do you have? Remember, we don't need to include adjustments to the final accounts because those ones are automatically, you have to do them. Then from the trial balance, we have what?
Income
What we
statement.
call final accounts. Final accounts, those income statement, final accounts. These are the final accounts altogether. Then again, you get back to transaction. So it's just a cycle that keep on rotating. Under trial balance, that is where we're going to do adjustments to the final account. We adjust accruals, we adjust prepayments. We can create, but not a mass, because we know that from this to get final accounts, lazima we do those adjustments. Accrual, we're adjusting accruals, we're adjusting prepayments. We basically adjust bad and doubtful debt together. But remember, accounting basically starts from the business transaction. What are examples of source document? Because that's the first thing that we need to start with, source documents. Source documents, stock vouchers. What are source documents, stock vouchers? And what are the examples of source documents, stock vouchers? Source documents, stock vouchers.
An example would be like an NPO.
Yes, those NPOs, delivery notes, are we together? Those are source documents altogether. Those are examples of source documents. What do you think are functions of those source documents?
Accountability purposes.
Accountability.
They provide information of what the transaction is about.
Providing information, that's very key. Providing information, really key. Providing information. So we need to understand that vouchers are all source documents. We say that business transactions, the first thing to understand is that business transactions are initially recorded in the source document. In the source documents. Are initially basically recorded in the source documents. Like when you go and you want a petty cash altogether, what will happen? It first be recorded in what? Petty cash voucher altogether. So they initially recorded in the source documents altogether. Source document, and say it's source document, voucher or source document, call a source document. Document is a documentary, what you call a documentary evidence, is a documentary evidence, what you call documentary evidence in support of transaction. In support of transaction. Transactions. In support of transaction. In support of transaction. Wherever you work, there's some noise. I'm giving you a break. Who is that making noise? Who is that making noise, tafadhali? Who is that making noise? I.e., we can have what we call sales invoice. Today, for example, you want to be reimbursed. Would it first you tell them I used 40,000, you need to reimburse me. Will they reimburse you, Jane? If you go to where you work and you tell them, look, I've spent 10,000. You need to reimburse me 10,000. Will they give you?
No.
You need this source document. For example, you realize that when you're traveling, you'll keep those receipts all together. When you buy something, you'll keep those receipts all together. Because, for example, we basically say that these source documents all together, they're basically documentary evidence in support of a transaction. If I travel all together, I need that receipt all together. I need that receipt all together in order to prove to the accountant that truly I traveled altogether. If I used, for example, credit altogether, my own credit, then I need to carry that scratch card and indicating the dates that probably it was within this date altogether. I bought this credit and this credit was used to facilitate. I made this call and this is the credit altogether. So basically, that's why we say that the documentary evidence in support of transaction. But the only way that we'll know that a transaction occurred is by using this source documents altogether. But these source documents are the ones that are going to prove that indeed transaction X, Y, and Z occurred. So importance of the source document, before I give you a small break, what you call importance of the source document. Importance of the source documents. This was also, we need to touch briefly, and then we'll pick up altogether. We need to touch them. I'll look for a way we summarize this, but very important. Before we move to those other things, especially this area, we're going to touch on a number of things that are very important for you. So what are the importance of this vouchers to stock document? Facilitate. We cannot record without this. Facilitate, one of the things that it does is facilitate the recording, what you call the recording of the transactions. Facilitate the recording of the transactions altogether. So we cannot record minus that. Then the second thing serves as internal control mechanism. If we are to open up an organization without this document, somebody can come and say, I used 30,000 and you give them, again, there will be no internal, serves as internal control. The next thing is that serves as internal control measure, serves as internal control, serves as internal control, so that nobody just comes to an organization. Then lastly, why those source documents are very important. We say that facilitate audit of transaction. Facilitate audit of transactions. Facilitate audit of transaction. As auditors who are here, how do you facilitate audit of transactions? How do you know that a transaction occurred? We've looked at the ledgers and other things. What will auditor look for? You look for those voucher stock receipts to know actually this transaction took place, that transaction took place. Is that true? Then after break, we take a small break. We talk about types of source documents, stock vouchers. Some we've mentioned types of source documents, stock vouchers. So we know that we also have invoices and many others. So we can have a small break. Then come back. Is that okay? A break of how many minutes? Then we come back. Jane, you're our leader. A break of
5. I think
5 minutes. 3, 5.
Yes.
So we have 5, so that others have not taken a break. I know let them have a small So we can resume from where we had stopped. I think our time is back now. We need to be back. Is that okay?
Yes.
So we can resume and we can stop at 30 there so that others can sleep, so that we don't stretch others too. So I want us to look at that. When you look at those notes, we start on topic 2, recording of transaction. Are you there on recording of transactions? Are you there on recording of transaction? The number of documents that have been indicated there: quotation, purchase order, statements of account. We have remittance advice. We have receipts. We have petty cash voucher, sales invoice, purchase invoice, credit note, debit note, bank statement. So a lot of times, particularly on these areas, you find a number of things that are basically asked altogether. They can choose, define the following term. What is a credit note? You can be asked, define the following term. What is a credit note? What is a credit note altogether? Maybe those questions are to 1 mark or 2 marks there. You can be asked what is maybe a debit note. What are receipts altogether? When you say receipts, what are they? So we'll pick the first one, the first book, the first source document or voucher. Vouchers, the first one, we call it quotation. What does quotation do? We can pick a few. What does quotation? What is the function of a quotation? When we say quotation, what does it do? Quotation as a source document, what does it do? Quotation, what does quotation do? What does quotation do when you talk about quotation? Quotation is used to let potential customer to know the cost of goods and services. Used to let the potential customer, we know that to let the potential customer know the cost of goods and services, before they decide to purchase them. I want to ask one of you, David, have you ever asked for a quotation? David, have you ever asked for a quotation? Somebody wants to sell for you something and tell me, give me a quotation. Yes. So that quotation basically, if you ask, is just simply used to let the potential customer know the cost. Customer know the cost of goods and services before they purchase goods. And maybe you can ask quotation from different sources altogether. Maybe ask quotation from A, quotation from B, quotation from C. And to know that. We have the second, which is purchase order. What is a purchase order? These are just purchase order. These are not very common. I know sales invoice is very common. They ask debit note, they ask a very common question. Credit note, they ask purchase order. Purchase order. PO, David, what a purchase order? We call it a commercial document. We call it commercial document. Call it a commercial document. We say issued by the buyer. Issued by the buyer to a seller. Issued by the buyer to a seller. Purchase order. What you need? Indicating. You need to know where it's come indicating. Indicating what you call types. What you need. Types, comma, quantities. Comma. And agreed prices for. And agreed prices for goods, agreed prices for products. Say instead of goods, just say products. And services the seller will provide this agreed prices of products and services. The seller will provide the buyer, will provide the buyer. You know, it gives you order after he has known, you know. Somebody will give you order after he has known the pricing and etc. Statement of account. What is statement of account as a source document? Statement of account. Statement of account. Basically, we don't even need to write it. When you talk about statement of account, you normally provide statements of account. Over and over, you provide them all together. But basically, it shows what has occurred. Transactions that have occurred, sales that have made, payments that have been made, checks probably that have bounced, that is statements of accounts together. But this is very important. Remittance note. What is a remittance note? Remittance note. What is a remittance note? Remittance note.
Is it the same as remittance advice?
Just define it.
It's a document that goes from the person from the customer, the person who is paying checks. Yes, the person who is making payment,
So
to the creditor.
We're saying that remittance advice is a letter sent by customer to a supplier. Are we together? To inform the supplier, to advise, sorry, we start with remittance, to inform the supplier that their invoice has been paid, altogether. If the customer is paying by check, are we together? The remittance advice often accompanies the check altogether. Remittance advice always accompanies the check, and that is what you've said. You say, see, that's true. Then you have the next what you call receipt. What is a receipt? Receipt is what? It always accompanies, when you talk about remittance advice, it always accompanies a check altogether. Always accompanies a check. You'll always find out that remittance, they're saying they're paying this and this invoice. Are we together? Are we together on remittance? What about receipt? Receipt is issued to a customer or a debtor when they make payment in form of cash or check altogether. When they make payment or in form of cash or check. So they're basically issued with the receipt. When they make payment in form of cash or check, they will be issued with a receipt. Is that okay? Tuko pamoja. Are we there, team? We respond if you're there. Are we there? If you're there, we respond with a yes. If we are there, we respond with a yes. Kindly, we respond. Is there anything that you're missing on this? Monique, Mercy, Ronald. Ronald says it's okay. Lavender, are you okay? Paris, are you okay? David Ochola, are we okay?
Yes,
Yeah.
okay.
Perfect, that's good. It just shows that you're very committed to the course. Then you have what you call the next, we can talk about petty cash voucher. What is a petty cash voucher? This was you read them, we don't even need to write them down. Petty cash voucher. What is a petty cash voucher? What is a petty cash voucher? These are basically small transactions that you don't need what? You don't need you don't need to write a check for altogether. So when they're issued through what? What you call a petty cash voucher altogether. That's why you say petty cash is a small amount of discretionary fund in form of cash used to for expenditure, where it's right sensible to make disbursement by check because of this inconvenience altogether. So that we use the petty cash voucher. Then a very common one that you find most of the time, sales invoice. What is a sales invoice? So if a company sells for you, maybe in credit, when they sell for you, are we together? The issue, what you call an invoice together. And you find
It's
that it's a Lavender.
It's a document demanding for payment.
Demanding for payment. So actually, once they issue goods, what follows is what? They send an invoice. They send an invoice. Are we together? And that invoice they demand for a payment altogether. I'm very happy. I want you as we stop at that point to check on purchase invoice, look at credit note, look at debit note, and lastly look at the bank statement altogether. After that, we'll move to the. So I'll move to the books of original entry. But these things are very important because if I start just doing financial statement of sole trader and I've not done double entry, I have not done the ledgers, some things you may not be able to understand, but you just go through them. Just make sure you read what I have given. Is that okay? Make sure you read what I've given and make sure you understand what I've given. Have you enjoyed our class? I'm so happy and I'm so proud of you. I was testing whether you can hang on, but you're ready to work. You're ready to work. And maybe a point of information, like tomorrow, always expect me by 8:15. Normally when you see the class is being set, it's normally set by 8:15. Are we together? So that is a point noted. So you wait for me until 8:15. Yes, that is when our class should be starting, around 8:15, 8:20. Is that okay, Tim? Is that noted?
Yeah.
As we stop at that point. Unless you have something. Me, I'm just happy. I know you're a committed team. What I can see is a committed team. And I can't wait to teach you to the end and make sure that we get what is required to be gotten. God bless you and have a great, 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 great night. Mbarikiwa. Unless somebody has something to say, I close it there. Unless somebody has something to say, I beg to close it there. We can leave. I see the class is still on. We can leave now. Yes.